So you've been saving for years in your IRA or 401k. But here's the twist. Someday the IRS will force you to start taking money out and paying taxes on these withdrawals. You knew that. Day's coming. But many are shocked by how these withdrawals will affect your taxable income and the 25% penalty if you don't get it right. It can cost you thousands of dollars. Today I'll walk you through 6 things you should know right now, no matter your age or where you are on your journey. So you've been saving tax-free for your retirement. Good for you. That's just what we encourage here at Ed Talk Media. But now you must start withdrawing a portion of it as taxable income. But whether you just turned 73 this year and must take your required minimum distribution now, or if you're several years off, here's what you need to know now. First, in the year you turn 73, you must make a withdrawal from these tax-deferred accounts by December 31st. This will result in taxable income, and it could possibly change your tax bracket and have other effects on your tax status. Failure to take the required minimum distribution will result in a 25% penalty on the entire amount of the required distribution. If your RMD is, say, $10,000 and you miss taking it, it'll cost you $2,500. The IRS is a serious bunch of folks over there. Next, IRS custodians, like your broker, are legally required to notify you by January 31st of the year beginning your RMD distribution requirement. So they'll tell you early in the year, hey, this year you're going to have to withdraw this. And most calculate the amount for you. That's good. But 401k custodians, on the other hand, are not legally required to notify you. You're kind of on your own here. Nevertheless, the RMD age requirement and calculations are the same, and you don't want to pay that 25% penalty. So regardless of your age, put that on your calendar. Your RMD is calculated each year based on your IRA or 401k balance on December 31 of the previous year, and further based on a life expectancy table produced by the IRS. The third, yes, there is a grace period, but only for first-timers. You can take that RMD up to April 1st. Now, I'm producing this video in early December 2025, and I strongly advise that if this is your first year, take it before the end of December. If you do wait, you'll end up taking the April deadline RMD for this year, and then another one by December of next year. You'll have 2 RMDs. And this could cause an enormous hike in your 2026 taxes. So I wouldn't rely on that April 1st extension for new people to the program. And fourth, if you're inclined to give to charities, now's the time. Why? Because your taxable RMD is reduced dollar for dollar when you make a qualified charitable distribution. So call that a QCD. Using the $10,000 example above, if you give, say, $2,500 to your charity or charities of choice, you've just reduced your RMD to $7,500. A few points to take into account here. A QCD must be an organization that is a qualified 501c3 organization that is eligible to receive tax-deductible contributions. This means it must be a public charity or operating foundation, not a private foundation or a donor-advised fund. Check with them to determine their status. I believe all churches qualify. If in doubt, check. These contributions must be made directly from your IRA. You can set this up with your broker. A couple of common ways to do this is get a checkbook on your IRA account and write checks to your charities. My broker will also set up regular payments like bill pay, say monthly, out of your IRA to a list of charities that you feel should be paid, say monthly. I mean, most people don't really want to wait till December to contribute to their church, for example, or their favorite charity. They'd rather pay them ratably throughout the year. Now, also third, this QCD benefit is only allowable for IRAs, not 401ks. Okay, the fifth point I want to make is, and here's the part that nobody knows, and it can save you from underpayment penalties. So if you're short on estimated tax payments during the year, say you're retired and you haven't made estimated tax payments during the year, the IRS Form 1040-ES, estimated tax for individuals, or withholding from your Social Security payments are 2 common ways to do that. The IRS will give you a huge gift when it comes to RMDs. listen to this. Any federal tax you withhold from your RMD, even if you wait until December, is treated as though it was paid evenly throughout the entire year, thus avoiding penalties that can arise from not making timely estimated tax payments. Think about that. Even if you didn't make estimated payments throughout the year, in December you can clean all that up. This single rule eliminates underpayment penalties for a lot of retirees. And I venture to guess hardly anybody knows about that. And since your taxes will likely be higher, I'm warning you, when the RMDs start hitting, you'll be surprised by the increase in taxable income and perhaps not prepared for this. Suggestion: when you take your December distribution, your custodian or broker may be able to withhold taxes directly for both federal and state. My broker does that. Number 6, if you're fortunate enough to have multiple traditional IRAs, you can combine all of your IRA RMD amounts and take the total from just one IRA if that's simpler, or you could take part from each. It's completely flexible, as long as you make the total amount of your required RMD for that year. This aggregation rule applies only to IRAs. It does not apply to 401ks or 403bs. Each of these plans must satisfy their own separate RMD. And by the way, here's a list of types of accounts subject to required minimum distributions. Accounts that do have RMD requirements are traditional IRAs, SEP IRAs, simple IRAs, 401ks, including solo 401ks, 403bs, 457b government plans, although I've never heard of them before, but they're on that list, and inherited IRAs. Accounts that do not have RMDs, at least during your lifetime, are Roth IRAs, Roth 401ks, and Roth 403bs. Now, disclaimer, I'm not a professional. I'm only trying to share what I know, so when in doubt, consult a professional. And finally, if you've now estimated that your tax bill is going to be higher this year than anticipated, here's a few things you might want to take a look at. First, changing your tax withholding on your Social Security payments. That might help next year. If you've taken gains in the stock market, like you sold that NVIDIA stock for a huge profit in a taxable account, but you also have some losers on the books, some losing stocks, consider tax loss harvesting to reduce your capital gains tax liability. You can sell some losing positions to offset some or all of the gains. Yep, you'll have to pay taxes on that big NVIDIA profit, unless, of course, it's in a tax-deferred account like an IRA. And as discussed before, if you're so inclined, give to a qualified charity. But, and I can't stress this enough, be sure the funds go directly from your IRA to the charity. This is a win-win situation, but it's only allowed for payments made directly from your account to the QCD. Well, hopefully this video is helpful wherever you are on your retirement journey. If so, please drop a comment below, and a like and subscribe is always appreciated. Be sure to ring the bell so you'll be notified when the next episode drops. And in the queue here at Ed Talk Media are these subjects: simple accounting for small businesses. Let's make that easier for everybody. Taxes for small businesses. And how about this one? Money lessons I wish I knew in my 20s and 30s. Until then, I'm Ed, and I'll see you next time on Ed Talk Media.